Hey, what's up guys, John here. A new law will require all banks to become fully dependent on the Fed.
The Fed and FDIC are looking at introducing a plan to require banks to tap the Fed's discount window at least once a year.
And when you start to look at what's happening right now, you're going to see a whole new type of banking system that is getting rebuilt right before our very eyes. And I believe with this change, we're going to see tens of thousands of bank branches close.
The Bank of America on Truxtun will be closing in February next year.
Community Bank and Citizens Bank have both filed plans to close branches in our area.
Santander Bank is planning to close 16 locations in Massachusetts, including 5 in Boston.
This isn't speculation. It's fact. That's what they're saying. They're saying prepare for a wave of bank failures, mergers, and a lot of bank branches just basically closing up shop. Instead, everything's going to go online. Prepare for this. I'm going to show you what Bloomberg is saying. I'm going to show you what the Fed is saying. And then at the end of the day, we'll look at the facts because facts matter and emotion changes day by day. Some people will say everything is going to be completely fine. Other people say it's not. I think we disregard all of that and we just look at the facts and make a decision based on that. Take a look at this. Please hit the like button. Hit the like button. YouTube will share this content, educate more people about what's happening in America's economy. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session. Take a look at this. So this is Bloomberg. U.S. preps rule to push more banks to use the Fed discount window. U.S. regulators preparing to introduce a plan to require banks tap the Federal Reserve discount window at least once a year to reduce the stigma and ensure lenders are ready for troubled times. I thought we were going to have a soft landing. The proposal, which is being drafted behind closed doors by the Office of Comptroller of the Currency, the Fed, and the FDIC, is the latest response to the last year's regional banking crisis. The turmoil spotlighted that some lenders weren't even set up operationally to quickly borrow from the window in a pinch. In an interview, Michael Su, the acting comptroller of the currency, said the changes of regulators will propose to aim to ensure banks are more prepared to respond to a sudden flight of deposits. We want to make sure that banks have enough resources to meet any kind of outflows within days, especially those related to uninsured deposits. He added that the plan will also seek to remove any stigma associated with borrowing from the Fed's discount window. Now, when you start seeing stuff like this from the Fed and the Office of Comptroller and the FDIC, to me, it's concerning, right? It signals that hard times are ahead. And then when you start looking at data points like 2023, 1,500 CEOs stepped down from their roles, a record high in American history. You have a lot of billionaires selling off tons of stock, some even buying, bunkers, and you start to see all this stuff and you're like, okay, well, is there going to be a soft landing? Because what the smartest people in the room are doing and what, banking, what's happening in banking, what's happening in all these different key markets inside of the economy, what they're all saying, what they're doing is completely different, right? I mean, they're saying Jerome Powell, Janet Yellen, soft landing, everything's going to be good. I don't know. It doesn't look like that way. Bolstering bank liquidity, backstops became a priority for U.S. regulators after several mid-sized lenders, including Silicon Valley Bank, failed last year. Since then, the government has called to the Federal Home Loan Bank, another source of funding, to direct lenders in the Fed in times of extreme stress. On Thursday, Su laid out several changes that regulators are likely to propose in the coming months. He said that lenders would also have to craft plans to borrow in a pinch, including collateral they pledge. So think about this. The Fed is increasing interest rates. Now they're setting a rule where they're going to have to put up their collateral to offset the damage caused by the Fed interest rate hike. And just for context, this is just 2022. This is the most aggressive tightening cycle in decades. You compare this to 1983, 1988, 1994, 1999, 2004, 2015. It's not even close. It's not even close. So when I say a rug pull, I mean a rug pull is coming. Banks would face a requirement to borrow from the discount window once a year to test their ability to do so. It's almost like doing a fire drill. If it's required when a real liquidity fire comes, then the banks can do it in real life, he said during the interview. Operationally, banks would have to borrow 100 million, whatever it might be, just to ensure that the procedures, the systems, the people, everything is there and in place to access the discount window. Su is the latest top U.S. regulator to flag the need for banks to be more comfortable with using the discount window. Banks need to be ready and willing to use the discount window in good times and bad. And so it said borrowing from the discount window, which dates back to the Fed's creation in 1913, has often carried stigma. The Fed itself discouraged borrowing from the facility in long periods throughout history, and banks were reluctant to use the facility ostensibly for institutions on the brink of insolvency for fears that investors would see this as a sign of weakness. Now, think about this. They don't want to do it because it shows a risk of insolvency. Now, all banks in America, every single bank, would be required to do this. What does that signal to you? Well, look at this. Wall Street Journal. Banks are ditching their branches. Maybe you should too. Well, it's because they know a lot of change is incoming. This came out about a month ago, 5 weeks ago. And when you look at what happened with banks, just in 2023, 3,000 bank branches closed, right? That's pretty substantial. Next year, visiting your local bank branch might get a little harder. But, say industry experts, if it nudges you to open an online savings or checking account, it might be a good thing. For decades, bank branches have been the fixture of America's Main Street, many built of handsome stone resemble miniature Greek temples. Now the nation's largest banks seem to be rushing to shut them down. Over the past 12 months, Wells Fargo closed 258 branches, JP Morgan Chase 165, Bank of America nearly 100. According to S&P Global Market Intelligence, in all, the number of bank branches in the U.S. has shrunk more than a fifth to 78,000 today from nearly 100,000 in 2009. Right? So over 15, 14 years, we just entered 2024. You lost 30,000 branches, right? Or 22,000 branches. Soft profits and aggressive cutting. So you start to just look at all this. Bank employees, they cut 60,000 jobs, which is shocking because in October 19th, the number was 20,000. Then Citigroup laying off 20,000. Then you have TD Bank closing out 3,000 roles. You have all these other banks closing out roles and positions. Now it's at 60,000 complete jobs just wiped out as of about 3 weeks ago. So it's very, very fascinating how fast this thing is moving. This train is moving really, really fast. Even some Fed officials are now questioning the Fed's new bank capital rules. So at the same time, they're requiring that banks tap in to the Fed for an emergency assistance. The Fed is also requiring them to do these new rules. Two Federal Reserve officials this week suggested changes to new bank capital rules proposed by their own agency, adding to the pressure on regulators to revise the controversial requirements. Fed Governor Michelle Bowman used a speech Wednesday before the U.S. Chamber of Commerce to argue that the plan needs substantial changes and that the increase in capital requirements at the scale proposed by regulators could significantly harm the economy. Higher levels of capital enhance financial resilience up to a point, Bowman said, but capital is not costless. Relying simply on the more is better approach downplays or ignores critically important trade-offs. Bowman's comments come one day after Fed Governor Chris Waller said the proposal has got to have a major overhaul, in my view, to get a reasonable product. One possibility, he added, is taking back and starting over. So the regulators have said the proposal would result in 16% increase in capital levels, meaning all that money that probably would have been lent out to small businesses and Americans now has to sit. And then 20% increase in risk-weighted asset for big banks. In the coming months, the banks have launched a campaign to roll back the new rules or scrap them entirely. Many banks submitted letters to the Fed listing the many problems they have with the new rules ahead of the deadline for those comments that ended on Tuesday. So you start to look at all of these big changes. Bank of America profit falls $3.7 billion, mainly because of all of this money that has to go into the FDIC, the Government Deposit Insurance Fund, for bailing out Silicon Valley Bank, First Republic, all these bank failures that we had last year. So you have all these banks, JP Morgan Chase, same exact thing. They had to pay a $2.9 billion fee for the regional bank rescue. So to me, I look at all this and I see a very, very, very unique situation giving the Fed extreme authority over 330 million Americans to the likes in which we've never before seen. I don't think we're going to see a Fed pivot anytime soon. I really don't. Especially look at December CPI report. What'd you see? You saw inflation getting, increasing. So if inflation's increasing, and they say that the goal is to bring inflation to a 2% number, what does that mean? They're likely going to increase interest rates further, put more pressure on banks, then require banks to do this. It's going to be it's going to be a very interesting year, to say the least. What do you think about this entire situation? Really curious, drop below. I think we're going to see a really, really big change in the economy, and I think we're going to see some really, really, really big winners. A lot of middle-class Americans rising up, looking at the facts of what's actually happening, but a lot of people just simply ignoring it, saying this will never happen. At the end of the day, as I've mentioned, facts are facts. I think it's wise to make decisions based on those facts. Hit the like button. YouTube will share the content. And if you'd like to fix your credit, we would love to help you at my company, GreatCreditFast.com. You can click the link in the description just below this video. If you have late payments, medical bills, charge-offs, or closures, bankruptcies, repossessions, I believe a lot of banks are going to tighten up lending dramatically. However, banks lend money into existence, so they're going to still need to lend money. It's just going to get harder to get access to it. So if you have bad credit, the odds of you getting funding for a real estate deal or a business loan or an auto loan, it's going to get a lot harder. Put yourself in the best position possible. Go to GreatCreditFast.com if you have credit issues, and I'll catch you next video.